$121 an ounce. That was the number. In late January 2026, silver didn't just rally, it went parabolic. We saw a 70% surge in a single month. Retail FOMO was at an all-time high. It felt like silver was finally having its 1980 moment, but then the floor dropped out. In just 7 trading sessions, silver wiped out 40% of its value, crashing back to the $70 range. We are officially witnessing a textbook blow off top. Today, we're doing a deep dive into the bull and bear cases for the rest of 2026. And I'm going to tell you why. Despite the silver squeeze hype, I'm firmly leaning toward the bear theory. First, let's give the bulls their due. Their case is built on physics, not just paper. The structural deficit. Silver is in its 6th consecutive year of a supply deficit. We're looking at a 200 million ounce shortfall in 2026. Industrial dominance. Solar installations are up 45% year over year. Between EVs, AI data centers, and the 5G rollout, silver is being consumed, not just stored in vaults. The Warsh factor. While the nomination of Kevin Warsh as Fed chair calmed the debasement trade temporarily, bulls argue that U.S. debt is still $35 trillion plus. They believe the safe haven bid will return the moment the first cracks in the labor market appear. To a bull, $70 silver is a gift, a chance to buy the dip before the next leg to $150. Now, here's why I'm skeptical. The bear case isn't saying silver is going to zero, but it is saying $121 was the peak for 2026. Here's why I'm leaning this way. The margin trap. The CME didn't just watch the rally, they smothered it. 3 margin hikes in 2 weeks forced leveraged traders to sell everything. When the paper market breaks this violently, it leaves a supply overhang. Millions of investors who bought at 100 pluses are now bag holders, waiting to sell the moment they break even. The Warsh Shock is real. The market was pricing in a dovish, politically pressured Fed. Kevin Warsh represents institutional discipline. This sent the dollar index, DXY, screaming back to 97.80. Silver pays 0 interest. When real yields rise, silver dies. Technical damage. We didn't just dip. We breached the 200-day moving average like it wasn't even there. Historically, when a commodity moves vertically and then drops 40%, it takes months, sometimes years, to rebuild a base. This isn't a V-shaped recovery, it's a long-term L-shape in the making. The final reason I'm leaning bear, positioning. In January, silver became the most crowded trade on the planet. Everyone from hedge funds to TikTok traders was on the same side of the boat. That is exactly when the boat tips over. We're seeing forced liquidations in Shanghai and ETF redemptions in the West. When the narrative moves from how high can it go to how do I get out, fundamental industrial demand, as great as it is, simply isn't enough to soak up all that speculative selling. Look, I love silver's long-term story, but for 2026, the blow-off has occurred. I expect us to chop between $60 and $85 for a long time, while the weak hands get shaken out. But what do you think? Are you buying this $70 discount? Or do you think $121 was the last time we see triple digits for a long time? Let me know in the comments. Don't forget to like and subscribe for more 2026 market deep dives. I'll see you in the next one.